चलो राइट डाउन हेडिंग ऑप्शन नंबर 2, उसमें हम लोग लिखेंगे in that we will write replace existing machinery. In that step number 1, investment. Dear students, if at all we replace existing machinery, then in that case there will be a cash outflow for purchase of new machinery 10 lakhs. Again there is a cash outflow of 2 lakhs, that is working capital. These two are cash outflows. There will be release of the existing working capital 1 lakh rupee in year 0 for the existing machinery, and the existing machinery can be sold for rupees 3 lakhs in the market. That is the way we will have the initial cash outflow. I request you to write down answer for the question. Buy new machinery, that is an amount of 10 lakhs plus working capital investment for the new machinery. Working capital investment is 2 lakhs less working capital recovery for existing machinery. It is an amount of 1 lakh. So to that extent you have to make less investment, so it will be shown with the negative sign. Less sale existing machinery. Dear students, it has been given that say we are going to sell existing machinery for an amount of rupees 3 lakhs. So the amount of the investment will be 10 plus 2 12, 12 minus 1 is 11, 11 minus 3, that comes to 8 lakhs. This is in the year 0. That is the way we will compute the initial investment. Step number 2, depreciation. From first year to fourth year. I request you to tell me answer that what would be the first year depreciation. Only first year depreciation. I request all of you to write down answer along with me. I'll explain that to you. In step number 2, first of all, working note number 1, calculation of WDV of machinery, comma, on which depreciation can be claimed. In that we will write opening WDV. Dear students, we understand that say as far as the existing machinery is concerned, its current WDV is 3,84,000. So we understand that say the opening WDV is 3,84,000 plus buy new machinery purchasing of the new machinery will be an amount of rupees 10 lakhs less sale existing machinery we understand that so the existing machinery can be sold for an amount of rupees 3 lakhs. So dear students, what will happen? We understand that as per the block of asset method of depreciation, we understand that say we can claim depreciation on 10 lakh 84,000. Yes, we have to start with the opening WDV. During the year, if at all there is any purchase of the machinery that is added to the value of the block, and if at all there is any sale of the machinery, it will be deducted from the sale value of the, that is say from the block. So this is the amount on which you can claim depreciation. So working note number 2, calculation of depreciation. In that, column number 1 is year, column number 2 is opening WDV, third column is depreciation. If at all we replace existing machinery, in the first year you can claim depreciation on 10 lakh 84,000 into 20 percentage. That comes to 2 lakh 16,800. This is the depreciation of the first year. I request you to take down answer. So in the second year, it is 10 lakh 84,000 minus 216,800. It is 8 lakh 67,200 into again 20 percentage. So 173,440. In the third year, it is 693,760. One three eight seven five two. Six nine three seven six zero. So 555,008. Again into 20%, 1,11,001.60. This is the way we compute the depreciation. Step number 3, terminal cash flow. I request you to write down answer for the terminal cash flow in the chat box. Step number 3, terminal cash flow. There is only working capital recovery. That is an amount of rupees 2 lakhs. It will be received year 4 end. Dear students, we understand that say there is no residual value of the machinery. That is the reason we understand that so the terminal cash flow will be 0 in terms of the scrap value of the machinery, and we have been provided that so there are several other machineries in the block. It means that so there is no capital gain or loss on sale of the machinery at the end of the fourth year. Step number 4, recurring cash flow. Dear students, in terms of the recurring cash flow, again, first of all, we'll prepare the working note for profit before depreciation and taxation, and then we'll make the calculation of the CFAT. Working note number 1, calculation of profit before depreciation and taxation. So column number 1 is particulars and column number 2 is answer. In that say we will have first of all the sales value. See, in terms of sales value, we will have working again like this. See, as per the information given, there are 300 working days in a year, working for 6 hours a day. So 300 into 6, it is 1800 number of hours in a year we are working. Multiplying with the output is given this time 40. So the output will increase, selling price is going to remain same, and with that say we will have the higher sales value, and so on working is required to be made. So in terms of the sales value we will write like this: 300 days into 6 hours per day. So it is 1800 hours multiplying with. The question is providing that say the output is 40 units per hour. So 40 units into selling price is 10. So what will happen, it is 1800 into 40. That comes to 72,000. Number of units into 10. That comes to 7,20,000. Accordingly, we are required to make further calculation. Next is cost of direct material. Friends, the question is providing the information that the cost of the direct material is 2 rupees per unit. So we understand that it is 72,000 into 2. That comes to 1,44,000. Next is cost of direct labor. It has been given that so the cost of direct labor is 30 rupees per hour. So we understand it is 1800 into 30. That comes to 54,000. Then we have been provided with the fixed overhead. It is provided as 60,000. Cash fixed overhead. It is 60,000. That's it. From revenue, all these expenses will be deducted in order to make the calculation of profit before depreciation and taxation. So I request you to use your calculator. 7,20,000 minus 1,44,000 minus 54,000 minus 60,000. That comes to 4,62,000. From this, depreciation is subtracted to compute PBT. Then we'll deduct the tax to compute PAT. Then depreciation is added back to compute CFAT. I request you to make the calculation of the CFAT and put your answer in the chat box. So next is calculation of cash flow after taxes. So, column number 1 is particulars. Opposite to that, it is first year, second year, third year, and fourth year. It is profit before depreciation and taxation less depreciation, then profit before taxes, income tax, profit after taxes, then we add back depreciation to make CFAT. That is the way cash flow after taxes can be calculated. So we understand that say we have to start answer like this: profit before depreciation and taxation 4,62,000 less depreciation. As far as year 1 is concerned, it is 2,16,800. 2,16,800. So what will happen, friends? 4,62,000 minus 2,16,800, that comes to 245,200. See, income tax rate information is given to us. Income tax rate is 30 percentage. So the income tax liability at the rate of 30% will be found. That is 73560. So 245,200 minus 73560, that is 171640, plus 2,16,800. So it comes to 3,88,440. That is the way the CFAT can be found. Similarly, we are required to do answer for the remaining years. 4,62,000 minus 173440. Next is 138752. Next is 111,001.6. Okay. Profit before depreciation and taxation will remain same, 4,62,000. So what will happen? It is 4,62,000 minus 173440. So 288,560 into 0.3, 86,568. It is deducted from 288,560. So 2,01,992 plus 173440. So 375,432. Next year same amount, 4,62,000 minus 138,752. So 3,23,248 into 0.3, 96,974.4. It is deducted from 3,23,248. So 2,26,273.60 plus 138,752. So 3,65,025.60. 462 minus 1,11,001.60. 3,50,998.4 into 0.3, 1,05,299.52. So 350,998.4 into 0.7 is 245,698.80, 0.88 plus 1,11,001.60, 3,56,700.48. This is the way the CFAT can be found from year 1 to year 4. Then step number 5 is NTE. In that, first year, second year, third year and fourth year cash flows will mention year 1 to year 4 this cash flow. Apart from that, say the working capital recovery 2 lakh rupees additional cash flow, that is discounted in present value term, and then we'll make the calculation of the, we will deduct the investment in year 0, that is 8 lakhs. Accordingly, we are required to make the computation of the NPV. So over here, the first year cash inflow is 388,440, 3,75,432, 3,65,025.60, then 3,56,700.48 plus the amount of the working capital recovery is 2 lakhs. So in that case, it comes to 5,56,700.48. Discounting of the cash flows at the rate of 10%. First year factor is 0.909. Second year it is 826, 751, 683. Present value. It is discounted in present value term for the purpose of NPV calculation. So 388,440 into 0.909, that is 3,53,091.96. 375,432 into 0.826, 3,10,106.83. 365,025.60 into 0.751, 2,74,134.23, 5,56,700 into 0.683, so 380,226.10. So the total of all of them is present value of the cash inflow less investment. Amount of investment we already have found, it is an amount of 8 lakhs in step number 1, and that will give us NPV. Please write down answer. So over here 353,091.96 plus 310,106.83 plus 274,134.23 plus 380,226.10, that comes to 1,317,559.12 minus 8 lakhs, that comes to 5,17,559.12. We can say that the NPV of the project is positive. So of course we understand that this is required to be compared with the first option for the purpose of decision making. So this is option number 2, that is compared with the option number 1. Option number 1 NPV is 460,780.74. It is less in comparison to the NPV with the replacement. So we'll advise the company to replace the existing machinery. So we understand that there is existing machinery and there is new machinery. NPV is found for both of them, and we understand that the NPV for the new machinery is more, so the company would advise to replace the existing machinery. Write down decision. Replace existing machinery. Now method number 2 of decision making. And of course, dear students, my suggestion to all of you is to go with the method number 2 of decision making, that is incremental approach. I request you to write down answer along with me. Incremental approach is adopted as replace over continuation with existing machinery. That is the way we'll adopt the incremental approach, that let us replace instead of continuation with existing machinery. I request all of you to write down answer along with me. Step number 1, investment. So we have to think like this. If at all we replace, then what happens? Over what would have happened otherwise if at all we would have continued with existing machinery. Dear students, if at all we can, that is, take the decision of the replacement, then in that case, step number 1, investment is going to remain same. That is, amount of the investment will be once again an amount of rupees 8 lakhs. That is what we understand. So step number 1, investment is rupees 8 lakhs, calculated like this. You may write entire, or you may just give a reference of the earlier working, and investment is 8 lakhs in year 0. So students who want to write the reference only may write like this. If the company replaces existing machinery comma, investment would be rupees 8 lakhs, ब्रैकेट में लिखो ईयर 0. Further in bracket write down, refer step number 1 of replace. So this is the way we give the reference, or you may write entire like this. Step number 2, depreciation. Dear students, of course you understand that, say, since it is an incremental approach, so it is the incremental depreciation. In that, there are two methods by which you can do answer. Method number 1 is like this. In step number 2, you can do answer by two methods. In that, method number 1 is like this. You compute the depreciation. If at all we replace, you compute the depreciation if we continue with the existing machinery, and then you compute the difference between both of them. This is the depreciation that you can claim if at all, say, you replace existing machinery, and this is the depreciation if at all you would have continued with existing machinery. Difference between both of them is incremental depreciation. So of course friends, we understand that, say, if at all you go for this method, then in that case you are required to prepare all the working notes that, say, we have done earlier for calculation of answer. So write down answer, incremental depreciation. We understand it is 2,16,800 with the replacement, 173,440 with the replacement, 138,752 with the replacement, 1,11,006, 1.6 with the replacement. And if at all you would have continued with existing machinery, first year it is 76,800, second year it is 61440, third year it is 49152, fourth year it is 39,320, 1.60. So what will happen, it is 2,16,800 minus 76,800, so 1,40,000. 173,440 minus 61,440. So it is 1,12,000. 138,752 minus 49152. 89,600. 1,11,000. 1.60 minus 39,321.60. That comes to 71680. So this is the way, the first method that we have to compute the incremental depreciation. Now method number two. Method number two will work like this. Let me explain you. Don't write anything. In method number two, we will have working of the answer in this way. Working note number one, calculation of incremental value of block. In a way that say, what is the incremental amount on which you can claim depreciation? It is purchase price of new machinery less sale value of existing machinery. Purchase price of the new machinery is 10 lakhs and sale value of existing machinery is 3 lakhs. So this difference of 7 lakhs is considered to be incremental value of block. Afterwards, working note number 2, calculation of incremental depreciation. In that we understand that it is first year, second year, third year and fourth year. It is an amount of 7 lakhs. 20% of that comes to 1,40,000. Then 560. Again 20% of that is 1,12,000. 4,48,000. Again 20% is 89,600. So 358,400 into 20%, 71680. This is the way the incremental depreciation can be calculated. You can see this matching with these values. In a way that so your substantial work is reduced, you can see. In the first method, what you have to do, friends, you're required to compute the depreciation for 6 years for the existing machinery. Okay, for the 6 years. First and second irrelevant, the later 4 is relevant. That is these values. If at all we continue with the existing machinery. If at all we replace, then you compute that, say what is the WDV on which you can claim depreciation. Then you compute the depreciation for 4 years, that is this. And then you compute the difference between both of them is the first method. Now understand, friends, what I have done in the second method. I request all of you to pay attention. See, we know that if at all we replace existing machinery, then in that case we can claim depreciation on 10,84,000. How it is 10,84,000? Opening WDV is 3,84,000 plus buying new machinery, it is 10 lakhs less sale existing machinery for 3 lakhs. So you can claim depreciation on 10,84,000 if you replace. And if at all you continue with existing machinery, then you could have claimed depreciation on 3,84,000. So difference of this two, is incremental value of the block, that is purchase price of the new machinery less sale value of existing machinery. So this is the incremental value of the block on which you can claim depreciation for 4 years. So this is what we understand is the conceptual working, that so you have to compute this 384, then you compute the new one on which you can claim depreciation, then you subtract the existing one. But this is again going to be quite lengthy. So better you have just making a comparison like this. One more important point, it may happen, it may happen that the question is silent about the price at which you had purchased the existing machinery. Then in that case, going with this method is not possible because you don't have this value. However, still this method is possible. Why? Because in method number 2, that is a shortcut method, you don't require that what is the WDV of existing machinery. So this is the incremental depreciation. Now friends, I am preparing one more working note. Why? I just explained that to you slightly later on. Working note number 3, calculation of present value of depreciation. So why we are doing it? Just 2 minutes. I'll explain that to you later on. First year, second year, third year and fourth year. This is the incremental depreciation. 1,40,000, 1,12,000, 89,600 and 71680. This is incremental depreciation. Present value factor at the rate of 10%. First year it is 909, second year it is 826, third year 751, fourth year 683. I request you to write an answer. What is the significance? I'll be able to explain that slightly later on. 1,40,000 into 0.909. So present value 1,27,260. 1,12,000 into 0.826. 92,512. 89,600 into 0.751. 67,000. 289.6. 71680 into 0.683. So it comes to 48,957.44. So this is the present value. 127,260 plus 92,512 plus 67,289.6 plus 48,957.44. It comes to 3,36,019.04. Please write an answer. Step number 3. Terminal cash flow. If at all we continue with existing machinery, it is an amount of 1 lakh. And if at all we replace, then in that case, it is an amount of rupees 2 lakhs. So if at all we replace, then in that case, there is an increase in terminal cash flow by rupees 1 lakh. 2 lakh minus 1 lakh. Okay, that's very simple. Working capital recovery is the only cash inflow. We understand that there is no cash flow in terms of the scrap value of the machinery. Step number 4, recurring cash flow. In that working note number 1, calculation of profit before depreciation and taxation. Dear students, my strong suggestion to all of you is that always prepare profit before depreciation and taxation for existing machinery and for new machinery separately. Do not try to make that the comparison individually. especially in a situation where the number of units are going to be different. So I suggest you to make the individual, that is say, to make the calculation separately for both of them, and then you compute so the incremental value. So with the replacement it is 4,62,000, and for the existing it is 1,52,000. So it is 4,62,000 and this is 1,52,000. So there is an increase. So 462 minus 152. So in that case it comes to 3,10,000. So if at all we replace the existing machinery, then in that case there will be an increase by 3,10,000. That is what we understand. That's very simple. Based on the information given, we are required to make the calculation. Now friends, I want to tell you that say how to make the calculation of NPV. See, what I want to tell you friends is that we can do this question in a short method. That is the reason say I want you to pay proper attention over here. Doing with the routine method is of course possible. However, I want to do with a short method. Let me explain you. Don't write anything. Step number 5. Calculation of NPV. Of course, the incremental NPV. Listen me carefully. It is year 1 to year 3, year 4. I am writing over here profit before depreciation after taxation. Then I am writing terminal cash flow, net cash flow, discounting at 10%. Then I am writing present value. Let me explain you. It is 3,10,000 is pre-tax. So what will happen, dear students? It is 3,10,000 into 1 minus 0.30. So it is 2,17,000. Profit before depreciation after taxation. This is the incremental one. Incremental terminal cash flow is 1 lakh. Net cash flow is 2,17,000 and then it is 3,17,000. Discounting for the first 3 years it is this 3. It is 909, 826, 751. So 2.486. Last year it is 0.683. I request you to keep some patience. I'll explain you logically all the points. So 2,17,000 into 2.486, that comes to 5,39,462. 3,17,000 into 0.683, 2,16,511, 539,462. So present value of the cash inflow 755,973. Now what we will do, dear students, we will add over here present value of depreciation tax saving. Yes, that is a new point for all of you. I explain that to you. 3,36,019.04 into tax rate 30%. So 3,36,019.04 into tax rate is 30%. So 1,0805.71. So total present value of the cash inflow 8,56,000 778.712. Less investment is 8 lakhs. That will give NPV. Amount of NPV will be 56778.712. That is the way NPV for the replacement can be calculated. Now friends, you can see that this is already calculated by us. 517559.12 minus 460780. It is exactly 56779.12. Even earlier we had the same amount, 56778.712. There is an approximation of only 1 rupee. So you can cross verify that say the way we have done answer is correct. So first of all, I have given you a cross verification that say this method is valid. Now I am giving you so the logical explanation of the new point of the depreciation. See, now I am explaining the important point of the question. I am absolutely sure that so all of you are clear with this portion, that is 3,10,000. There is no doubt about it. Everybody is clear with the amount of the depreciation. I am sure for that. Now, the way we do in routine, just understand that the kind of working that we do in routine is this: year 1, year 2, year 3, year 4. The amount of incremental profit before depreciation and taxation is 3,10,000 for first year, 3,10,000 for the second year, 3,10,000 for the third year, 3,10,000 for the fourth year. Then we deduct the depreciation. You don't have to write anything. Let me explain you. 140, 112, 89,600 and 71680. 140, 1,12,000, 89,600 and 71680. Now it is 3,10,000 minus 1,40,000. So it is 1,70,000 into 0.3, 51,000. It is deducted from 170. This is 119. Then you add back depreciation 140. So you find CFAT 259. Now instead of this, listen carefully. Instead of this, what we can do, dear students, 3,10,000. You compute directly the tax liability, 93,000. So you make it post tax. It is 2,17,000. We understand that say actually the income tax liability is only 51,000. Instead of that, say we have mentioned the income tax liability 93,000. Income tax liability is actually less due to depreciation. It is 1,40,000 into 0.3. So there is depreciation tax saving of 42,000. It is added to 2,17,000. So it comes to 259. Because depreciation is basically a non-cash item. So there is no cash outflow, but it is only giving the tax saving cash inflow. So what we understand, directly we can make profit before depreciation and taxation post tax. And then we add depreciation tax saving, that is DTS, and we can compute CFAT. Now explaining in second year, 3,10,000 minus 112. So it is 198 into 0.3, 59,400. It is deducted from 198. So it is 138,600. Then you add 112. So it is 1,12,000 plus 138,600. So 250,600. Now instead of this, what you can do, dear students, 3,10,000 minus income tax. So it is 2,17,000. Again, the tax amount is wrong. Actually, the tax amount is only 59,400 and not 93,000. Why? Because of the depreciation. Depreciation is a non-cash item and it is able to give you the tax shield. So 1,12,000 into zero point 0.3. You get the depreciation tax shield of 33,600. It is added to 2,17,000. So that comes to 250,600. So you get the same answer. So what you can do, you can compute the profit before depreciation after taxation, and then you add a depreciation tax shelter separately, that is depreciation into tax rate. Now same way for the third year and same way for the fourth year. Okay, now listen carefully what I'm going to speak. This cash flow after taxes is discounted in present value term to calculate NPV. So this cash flow after taxes is divided into two parts. It is divided into two parts. One is this 2,17,000, 2,17,000, 2,17,000, 2,17,000. So what I have done, friends, over here, I have mentioned 2,17,000 on the yearly basis. And I have discounted the same at 10% for 4 years. This terminal cash flow is okay. That's absolutely the way we do it normally. And we find this present value of the cash inflow. But this present value of the cash inflow is excluding the effect of the depreciation tax saving. Okay, now listen carefully. Depreciation tax saving for the first year is 42,000, second year it would be 33,600, third year it would be some value, fourth year it would be some value. And then it is supposed to be discounted in present value term to calculate NPV. So what we are doing, dear students, depreciation tax shelter is equal to depreciation into tax rate. And then present value of depreciation tax shelter is equal to depreciation into tax rate, depreciation tax shelter into PVIFA at the rate of 10% for 4 years. I'm sorry. Into individual year factor, because every year so it would be different. So first year, second year, third year and fourth year. So now the working that we have done is, listen carefully, the working that we have done is, we have calculated present value of the depreciation into income tax rate will give present value of depreciation tax saving. See, depreciation into tax rate is depreciation tax shelter. Then you discount is present value of depreciation tax shelter. Depreciation into tax rate is depreciation tax shelter. Then you discount. But I have changed the order. What I am doing, I am calculating first of all the present value, and then whatever the present value of the depreciation, that is multiplied with the tax rate. That is what I have done over here. Present value of depreciation tax saving. It is depreciation in present value term into tax rate. That is the way we compute the answer. See, why do I recommend this method, dear students? I am recommending this method because this is a 10 marks question in examination. Doing it, say, with a longer method will be time consuming. See, in step number 4, you can do working like this, the way I have done over here. Then you can have the individual discounting. However, that is going to be time consuming. See, this question is of only 4 years. But imagine if it is of 10 years, then yes, institute publication questions are there which are of 10 years. Doing 10 years question like this would be extremely time consuming. That is the reason I strongly recommend all of you to do answer like this. I just give a small summary, not in detail, small summary. Step number 1 is investment. That is what we do normally the way. Step number 2 is slightly important step. First of all, you compute the incremental value of the block. This is the incremental value of the block. Simply compare purchase price of the new machinery with the sale value of existing machinery. You will get incremental value of the block. See, I have explained you the logic also. I do not want you to cram, because the new value of the block is calculated taking opening WDV, and then it is later on subtracted. So if it is supposed to be subtracted, then in that case, let us ignore it and let us make a comparison of this two. Step number 2, incremental value of the block. Then in the step number 2, you compute the incremental depreciation and its present value. You can add over here only the present value factor column, and you can compute its present value. Step number 3, terminal cash flow, that's very nominal. Profit before depreciation and taxation, that is of course not at all new for you, and you should be having such a good grip of doing this working. Step number 5, NPV I am doing. See what I am doing: profit before depreciation after taxation, terminal cash flow, discounting in present value term, and present value of the depreciation tax saving, and with an NPV is found. Imagine 10 years question. And dear students, the institute has provided these kind of the questions in its publication, so we cannot ignore them, and you need to be prepared for this kind of shortcut working. So now one line answer, and I'll dictate a note to you for that. And we have even cross verified this answer, that the replacement and the continuation with existing machinery has exactly this much difference. Read an answer. Decision is replace existing machinery full stop. And friends, the reason that I do with the both is to give you a conceptual clarity. Doing only with the incremental approach may not give you that confidence. That is the reason I have done by both the methods. Now write down a note. In case of incremental approach, comma, if block of asset method of depreciation, block of asset method of depreciation is followed, comma, then incremental value of block is difference between purchase price of new machinery and sale value of existing machinery. Full stop. Make this as first point. Write down second point. Depreciation is a non-cash item. Full stop. It only gives tax savings. Full stop. So we may compute depreciation tax savings separately as under depreciation into tax rate. Full stop. Dear students, in all the questions, I do not suggest you to go with this depreciation tax saving method, because there is a small limitation of this method, small limitation, that if at all there is a loss in the initial years, then in that case, the depreciation tax saving would not arise if we are going to carry forward the loss. So in that exceptional situation, this method does not prove to be correct. In that case, some other calculations are to be made. So I do not suggest generally to follow this method. Generally, you follow the routine method, conventional method, because that is always going to give you the correct answer. But in this kind of exceptional question, I suggest you to do this method to save your time.